unprecedented decrease in the number of departmental stores, coupled with a whopping decline in footfall in once crowded, throbbing malls and showrooms. These sharp, dynamic changes in customer approaches, consumer mindset, and industry trends are knocking on the exit door for the brick-and-mortar retail industry. Well, long gone was the time when people preferred shopping by visiting stores, showrooms, and malls. Stores are filing for bankruptcy, and the pandemic has only worsened things. But is it bothering you that how come a prime marketing industry that constitutes almost 5% of the entire gross domestic product of the United States has entered its last phase? In today's video, we will try to decode just that. Together, we will understand the forces at play, the factors that brought about this problem, and the parameters of transformation. Welcome to The Wealthy Mindset, where we explore unique and breathtaking angles from the world of money, economics, personal finance, and investing. But before we get started, do not forget to like this video and subscribe to the channel to never miss another video. The retail industry is a primarily three-segment market, comprising the A. Food products, B. Consumer goods, and C. Durable consumer goods. Characteristically, four major types of retail stores have been prevalent in markets, namely A. Fixed locations retail stores, B. Supermarkets, C. Temporary shops, and D. On-demand retail outlets or vending machines. But with the advent of e-commerce and large-scale handlers in general, a phenomenon called the retail apocalypse has set in. Retail apocalypse signifies the migration of customers from physical retail outlets such as stores and supermarkets, to e-commerce and online websites. It is a disaster for them. Well, who is to blame? Honestly, no one. The customer sure can't be blamed for choosing a more convenient alternative. The numbers are enough to speak of it, especially in the United States. It's not that people have stopped buying, but the turf has now changed. From as low as 2% back in 2008, online retail websites have now captured 16% of the U.S. retail industry as of the first quarter of 2020. There has been a constant decline in the departmental store revenue, too, coming down from a whopping $16 billion in 2008 to a meager $6.2 billion in 2020. According to earnings reported at the beginning of 2020, annual profit declined for Kohl's, Macy's, Dillard's, Nordstrom, and JCPenney. The decreasing foot traffic and the pressures of lockdowns have resulted in a slew of departmental stores filing for bankruptcy, including some giants like JCPenney, Neiman Marcus, Stage Stores, Steinmart, and Lord & Taylor this year. Depreciating sales and progressing debt with the pressure of prolonged lockdowns have wreaked havoc on the retail establishments. Not only that, the number of stores in the U.S. have come down from 8,625 in 2011 to 6,297 in 2020, with an estimate of 2,000 further closures in the next 5 years. JCPenney announced it would close around 200 stores this financial year, with 50 more to follow next year. Macy's 20% closure of all its stores only adds to the narrative. According to the Green Street Advisors, almost half of retail stores and malls have closed by the end of 2021 itself. With huge rent debts of $52 billion, most of these malls, which are getting vacant, have turned into mixed places ranging from hotels, office spaces, to schools, and massive warehouses for online giants. One prime example includes the famous Los Angeles West Side Pavilion that used to house Macy's and Nordstrom, has now been converted into a Google regional office. The Wall Street Journal reported that Simon Property Group, the biggest mall operator, was discussing turning some of their 11 Sears and 63 JCPenney stores, both bankrupt, into fulfillment centers for none other than their biggest competitors, Amazon. The situation is terrible and worsening every day. Lest the retail owners swallow the bitter pill and adapt or improvise to changing times. Why though? What happened? Firstly, and most importantly, the price and opportunity cost involved with brick-and-mortar retail shops is exceptionally huge as compared to the emerging online retail websites, and consequently, consumers have shifted to shopping websites. Who doesn't want to save money? Who in their right mind would not prefer a discount that they wouldn't otherwise get in a retail shop? Over and above, who will prefer investing time and fuel to drive down a physical store to shopping from the comfort of their bed? Almost every brand in the world, including ones that produce or sell products such as food items, fresh fruits, clothes, footwear, household items, luxury products, and electronics, apart from others, have their dedicated websites that deliver at your doorstep. Secondly, the emergence of companies like Amazon and eBay, among various others, have only worsened things for them. What it has given to the customers is choice. The choice and freedom to compare and buy from the online outlet they prefer. This has given customers a huge variety of products, ranging from cheap, affordable items to completely lavish luxury products. Essentially today, if you want to buy a Rolex watch, you really don't need to walk down the mall. You can just order it online. Earlier, physical bookstores were a booming business. But the huge diaspora of availability and plethora of genres have attracted readers to shop online. Thirdly, the physical retail business model does not really prove profitable, at least for a majority of outlets evident from rising filing of bankruptcy. Sky-soaring rents at prime locations, apart from constant maintenance costs, occur more liabilities as compared to an online setup. The online site eliminates the role of retailers completely by adapting a direct business-to-consumer, or D2C, direct-to-consumer business model, where smaller companies with less revenue can also find a place on the online rack. Physical stores have failed in that department. Fourthly, the problem with multiple stores and malls pretty close to each other has led to a saturation point for customers. Well, in plain terms, people are fed up with brick-and-mortar establishments in the city, so much so that the growth rate of malls between 1975 and 2012 in North America was double the population growth. That's right, and the consequence? Well, 50% of them have already shut down or filed for bankruptcy between 2010 and 2013. Essentially the problem aplenty, yet again. The last nail in the coffin was delivered by poor management, the condition of which was worsened by the pandemic. Poor management has involved prioritizing short-term, higher payrolls by impricely controlling inventory stocks of different products, resulting in a very poor shopping experience. This gives rise to empty racks in the aisles. Most of the big retail chains are also burdened under long-standing debts, often from private equity firms. Finally, the COVID-19 outbreak and the lockdown imposed forced shutdowns for physical retail stores, while online aggregate warehouses considered essential services. Consumer behavior drastically changed as 29% of the U.S. consumers and 43% of UK consumers stated in a survey that they never want to return to offline shopping anymore. Well, that speaks for itself, doesn't it? People really don't want to visit stores or retail chains to buy clothes anymore. They would rather just add it to their Amazon cart and order it. And unless brick-and-mortar retail outlets adapt to online landscape, havoc shall continue to wreak upon them. What do you think about this constantly spreading phenomenon? Name one product that you have to buy offline, something that you just would not want to purchase online. Can you think of one? Share with us in the comment section below. Slap that like button if you loved what we told you today. Subscribe and hit the bell icon below to never miss another Wealthy Mindset video, especially if you're interested in unexplored topics and interesting stories just like this one. We hope you enjoyed the video, and we'll see you next time.